An investor invests 2 lakh annually for 6 years in a liquid fund offering 7.5% compounded annually with high liquidity, and alternatively in a fixed deposit offering 6.5% simple interest with a 3-year lock-in. Calculate the corpus for both options at the end of 6 years and identify which option provides better liquidity and corpus. Here are your options. A. Liquid fund corpus 15,62,000, FD corpus 13,80,000. Liquid fund better liquidity and corpus. B. Liquid fund corpus 13,80,000, FD corpus 15,62,000. FD better liquidity and corpus. C. Liquid fund corpus 15,62,000, FD corpus 13,80,000. FD better liquidity but lower corpus. Or D. Liquid fund corpus 13,80,000, FD corpus 13,80,000. Both have same corpus but liquid fund better liquidity. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Liquid fund corpus, compounded, FV equals 2 lakh asterisk 1.75 carat 6 minus 1 divided by 0.75, 15,62,000. FD corpus, simple interest, total investment equals 12 lakh, interest equals 12 lakh into 6.5% into 6 equals 4,68,000. Total equals 16,68,000, but lock-in limits liquidity. Liquid fund offers better liquidity and a corpus close to FD. A mutual fund has an exit load of 1.5% if units are redeemed before 1 year. An investor redeems 2 lakh units at NAV 50 after 9 months. Calculate the amount received after deducting exit load and explain its impact on liquidity and returns. Here are your options. A. 98,50,000 received. Exit load reduces liquidity and net return. B. 98,50,000 received. Exit load impacts returns but liquidity remains unchanged. C. 98,50,000 received. Exit load reduces returns and liquidity due to penalties. Or D. 98,50,000 received. Exit load has no impact on liquidity but reduces returns. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Amount before load equals 2 lakh into 50 equals 1 crore. Exit load equals 1.5% into 1 crore equals 1,50,000. Amount received equals 98,50,000. Exit load reduces net returns and penalizes early withdrawal, adversely affecting liquidity. An investor invests 1 lakh in a 5-year tax-saving fixed deposit at 7% simple interest, taxed annually at 30%. Alternatively, the investor invests in an ELSS with expected 15% CAGR and 10% long-term capital gains tax after 3 years. Calculate and compare post-tax corpus of both after 5 years. Here are your options. A. FD post-tax 11,550, ELSS post-tax 20,100. ELSS better. B. FD post-tax 11,550, ELSS post-tax 18,500. FD better. C. FD post-tax 11,550, ELSS post-tax 20,100. FD better. Or D. FD post-tax 11,200, ELSS post-tax 18,500. ELSS better. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. FD interest equals 1 lakh asterisk 7% asterisk 5 equals 35,000. Taxed annually reduces effective post-tax interest to 24,500 approx. Total equals 1 lakh 24,500 approx. ELSS corpus FV equals 1 lakh asterisk 1.15 carat 5 equals 2 lakh 1,135 rupees. Long-term capital gains tax 10% on gain equals 10% asterisk 2 lakh 1,135 minus 1 lakh equals 10,113 rupees. Post-tax equals 1 lakh 91,122 rupees approx. ELSS yields higher post-tax corpus. An investor wants to invest 5 lakh for 5 years in a government bond yielding 7% compounded annually or a fixed deposit at 6.5% compounded annually. Calculate maturity amount for both and explain the risk-return trade-off. Here are your options. A. Government bond 7,01,000, FD 6,91,000, bond better returns but higher risk. B. Government bond 7,01,000, FD 6,91,000, bond better returns and safer. C. Government bond 7,01,000, FD 6,91,000, FD better returns and safer. Or D. Government bond 6,91,000, FD 7,01,000, FD better returns but riskier. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. Government bond FV equals 5 lakh asterisk 1.75 carat 5 equals 7 lakh 1,000 approx. FDFV equals 5 lakh asterisk 1.65 carat 5 equals 6 lakh 91,000 approx. Government bonds generally safer with sovereign guarantee and offer better returns. An investor wants to accumulate 10 lakh in 4 years and can invest in either a savings account offering 4% simple interest or a mutual fund with 10% CAGR compounded annually but moderate risk. Calculate required annual investment in each to meet the goal. Here are your options. A. Savings account 2,27,273 annually. Mutual fund 1,95,000 annually. B. Savings account 1,95,000 annually. Mutual fund 2,27,273 annually. C. Both require 2 lakh annually. Or D. Savings account 2,50,000 annually. Mutual fund 1,50,000 annually. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Savings account simple interest FV equals P into N asterisk 1 plus R equals P into 4 into 1.4. To get 10 lakh, P into 4.16 equals 10 lakh. P equals 2,40,384 approx. Mutual fund compounded FV equals P asterisk 1.10 carat 4 minus 1 slash 0.10 equals P into 4.641. P equals 2,15,500 approx. Adjusted for periodic investments, slightly lower for mutual fund. An investor pays an exit load of 1% for mutual fund redemption within 1 year. If 5 lakh invested grows at 10% CAGR and redeemed at 10 months, calculate the effective return after considering the exit load. Here are your options. A. Investment value 5,50,000, exit load 5,500, net 5,44,500. B. Investment value 5,50,000, exit load 5,000, net 5,45,000. C. Investment value at 10 months 5,41,000, exit load 5,410, net 5,35,590. Or D. Investment value 5,41,000, exit load 5,000, net 5,36,000. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Value after 10 months equals 5 lakh asterisk 1 plus 0.10 carat 10 by 12, 5,41,000. Exit load equals 1% of 5,41,000 equals 5,410. Net redemption equals 5,35,590. Exit load reduces effective returns and liquidity. An investor has 2 lakh to invest annually for 10 years. If 40% is allocated to a debt fund yielding 8% annually and 60% to an equity fund yielding 14% annually, what is the expected corpus after 10 years? Here are your options. A. Debt corpus 29,50,000, equity corpus 88 lakh, total 1,17,50,000. B. Debt corpus 2,95,000, equity corpus 8,80,000, total 11,75,000 in lakhs. Or C. Debt corpus 2,95,000, equity corpus 8,80,000, total 11,75,000 in lakhs. Or D. Debt corpus 29,50,000, equity corpus 88 lakh, total 1,17,50,000 in lakhs. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Debt fund FV equals 80,000 asterisk 1.8 carat 10 minus 1 by 0.8 equal to 29,50,000. Equity fund FV equals 1,20,000 asterisk 1.14 carat 10 minus 1 by 0.14 equal to 88 lakh. Total corpus equals 1 crore 17,50,000. An investor wants to minimize tax outflow on a 2 lakh investment, choosing between a 5-year tax-saving FD at 7% taxable at 30% annually and an ELSS with expected 15% CAGR with 10% LTCG tax after 3 years. Which option yields higher post-tax returns after 5 years? Here are your options. A. Tax-saving FD post-tax 2,20,000, ELSS post-tax 3,60,000, ELSS better. B. Tax-saving FD post-tax 2,31,000, ELSS post-tax 3,10,000, FD better. C. Tax-saving FD post-tax 2,20,000, ELSS post-tax 3,10,000, FD better. Or D. Tax-saving FD post-tax 2,31,000, ELSS post-tax 3,60,000, ELSS better. Take a moment to pause the video and decide. The correct answer is Option D. Let's see why. FD interest equals 2 lakhs asterisk 7% asterisk 5 equals 70,000. After 30% tax equals 49,000. Total equals 2 lakhs 49,000 approx. ELSS FV equals 2 lakhs asterisk 1.15 carat 5 equals 4 lakhs 3,000. LTCG tax equals 10% on gain equals 20,300. Post-tax equals approx 3,82,700. ELSS yields higher post-tax returns. An investor needs 5 lakh in 1 year, short term, and 20 lakh in 10 years, long term. Which investment approach minimizes risk and maximizes returns? Here are your options. A. 100% liquid funds for both goals. B. Short term in savings account, long term in equity mutual funds. C. Short term in debt funds, long term in equity mutual funds. Or D. 100% FD for both goals. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Debt funds provide moderate returns with low risk, suitable for short term. Equity funds offer higher returns for long-term goals. Thus, this mix balances risk and return. An investor redeems 1,000 units of a mutual fund at NAV 100 after 6 months with 0.5% exit load applicable within 1 year. Calculate amount received after exit load and impact on liquidity. Here are your options. A. 99,500 received. Exit load reduces liquidity. B. 99,500 received. Liquidity unaffected but returns reduced. C. 1 lakh received. No exit load as within 1 year. Or D. 99,000 received. Exit load reduces liquidity and returns. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Amount before load equals 1,000 into 1 lakh equals 1 lakh. Exit load equals 0.5% into 1 lakh equals 500. Net received equals 99,500. Exit load reduces liquidity by penalizing early exit. An investor with low risk appetite wants capital protection and moderate returns for 3 years. Which portfolio mix is ideal? Here are your options. A. 100% liquid funds. B. 100% equity mutual funds. C. 70% fixed deposits, 30% balanced mutual funds. Or D. 50% equity mutual funds, 50% liquid funds. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Fixed deposits offer capital protection and stable returns. Balanced funds add moderate growth. This mix suits low risk with moderate returns. For a financial goal of 50 lakh in 20 years, an investor currently has 5 lakh and can invest 1 lakh annually. Assuming 10% CAGR, will the corpus be sufficient? Here are your options. A. No, corpus will be approx 45 lakhs. B. Yes, corpus will exceed 50 lakhs. C. No, corpus will be approx 40 lakhs. Or D. Yes, corpus will be exactly 50 lakhs. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Future value of lump sum equals 5 lakh asterisk 1.1 carat 20 equals 33 lakh 60,000. FV of annuity equals 1 lakh asterisk 1.1 carat 20 minus 1 slash 0.1 equals 6 lakh 72,000. Total approx 1 crore, exceeding target. An investor invests 2 lakh annually in a tax-saving FD at 7% with 5-year lock-in, taxed at 30%. And alternatively in ELSS with 15% CAGR and 10% LTCG tax after 3 years. What is the post-tax corpus after 7 years for each? Here are your options. A. FD 16 lakh 20,000. ELSS 23 lakh 50,000. ELSS better. B. FD 16 lakh 20,000. ELSS 21 lakh. FD better. C. FD 15 lakh. ELSS 23 lakh 50,000. ELSS better. Or D. FD 15 lakh. ELSS 21 lakh. FD better. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. FD post-tax returns are reduced by 30% tax on interest. ELSS benefits from higher CAGR and lower LTCG tax, resulting in higher post-tax corpus. An investor has 2 lakh to invest annually for 6 years. Comparing a liquid fund at 7% CAGR and a fixed deposit at 6.5% simple interest with 3-year lock-in, calculate the corpus for each and recommend which meets short-term liquidity and long-term growth needs. Here are your options. A. Liquid fund corpus 9 lakh 10,000, FD corpus 8 lakh. FD better for liquidity. B. Liquid fund corpus 8 lakh. FD corpus 9 lakh 10,000. FD better for growth. C. Liquid fund corpus 9 lakh 10,000. FD corpus 8 lakh. Liquid fund better for growth and liquidity. Or D. Liquid fund corpus 8 lakh. FD corpus 8 lakh. Both equal. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Liquid fund compounded. FV equals 2 lakh asterisk 1.7 carat 6 minus 1 by 0.7 equals 14 lakh. FD simple. Total investment equals 12 lakh. Interest equals 12 lakh into 6.5% into 6 equals 4 lakh 68,000. Total equals 16 lakh 68,000, but lock-in limits liquidity. Liquid fund offers better liquidity. An investor allocates 10 lakh in a government bond yielding 7% annually compounded for 5 years versus fixed deposit at 6.5% compounded annually. Calculate maturity amounts and explain the tax implications if investor is in 30% tax bracket. Here are your options. A. Government bond matures at 14 lakh 3,000, FD at 13 lakh 91,000. FD interest taxable annually, government bond exempt. B. Government bond matures at 14 lakh 3,000, FD at 13 lakh 91,000, both fully taxable annually. C. Government bond matures at 13 lakh 91,000, FD at 14 lakh 3,000, FD interest exempt. Or D. Government bond matures at 13 lakh 91,000, FD at 14 lakh 3,000, both exempt. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Government bond FV equals 10 lakhs into 1.7 to the power 5 equals 14 lakhs 3,000. FD FV equals 10 lakhs into 1.65 to the power 5 equals 13 lakhs 91,000. FD interest taxable annually at 30%, reducing returns. Some government bonds may offer tax benefits. An investor considering tax deduction on investment of 1,50,000 in a product with 3-year lock-in at 8% interest compounded annually, if marginal tax rate is 30%, calculate effective post-tax return considering tax deduction benefit. Here are your options. A. Gross corpus after 3 years, 1,80,000, post-tax 1,71,000, effective return 6%. B. Gross corpus after 3 years, 1,89,000, post-tax 1,71,000, effective return approx 7%. C. Gross corpus after 3 years, 1,89,000, post-tax 1,89,000, effective return 8%. Or D. Gross corpus after 3 years, 1,80,000, post-tax 1,89,000, effective return 7%. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. FV equals 1,50,000 asterisk 1.8 carat 3 equals 1,89,000. Tax on interest equals 30% of 39,000 equals 11,700. Post-tax equals 1,77,300. Considering tax deduction, 1,50,000 reduces taxable income by 45,000. Net benefit improves effective returns. If an investor's annual return expectation is 10% with 6% inflation, what is the real rate of return? And which asset class typically meets this real return over long term? Here are your options. A. Real return 3.77%, equity mutual funds. B. Real return 4%, fixed deposits. C. Real return 3.77%, debt funds. Or D. Real return 4%, savings account. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Real return equals 1 plus nominal rate divided by 1 plus inflation rate minus 1 equals 1.10 slash 1.6 minus 1 equals 3.77%. Equity mutual funds historically provide such real returns over long term. An investor is comparing two investment options for a 7-year goal of 20 lakh corpus. Option 1 is a 7% annual tax-saving FD with 5-year lock-in taxed at 30%. Option 2 is an ELSS with 15% CAGR and 10% LTCG tax after 3 years. Assuming 2 lakh invested annually, which option yields higher post-tax corpus? Here are your options. A. Both yield the same post-tax corpus. B. ELSS yields higher post-tax corpus. C. Cannot determine without inflation data. Or D. FD yields higher post-tax corpus. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. ELSS with higher CAGR and lower LTCG tax yields a better post-tax corpus compared to FD taxed annually at 30% interest. An investor plans to invest 1 lakh annually for 5 years in a product offering 8% compounded annual interest with a 3-year lock-in and a tax deduction available under Section 80C. The investor is in a 30% tax bracket. Alternatively, the investor can invest in a liquid fund expected to yield 7% CAGR with no lock-in but no tax benefits. Considering the tax deduction and lock-in trade-off, calculate and compare the effective post-tax corpus at the end of 5 years for both options and identify which investment is better for maximizing post-tax returns without compromising liquidity significantly. Here are your options. A. Product with lock-in yields 4,58,000 after tax. Liquid fund yields 4,03,000. Product is better due to tax benefit despite lock-in. B. Product with lock-in yields 4,03,000 after tax. Liquid fund yields 4,58,000. Liquid fund is better due to liquidity. C. Both yield approximately 4,30,000 after tax. Choice depends on liquidity preference. Or D. Product with lock-in yields 4,80,000 after tax. Liquid fund yields 3,90,000. Product is better even ignoring liquidity. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. The product offers 8% CAGR compounded annually with tax deduction on investment, effectively reducing taxable income, which increases net returns. After 5 years, the corpus grows higher even after accounting for tax on maturity proceeds. The liquid fund, although providing liquidity and 7% CAGR, lacks tax benefits and is fully taxable on gains. Calculations show the product yields approximately 4,58,000 post-tax, while the liquid fund yields 4,03,000, making the product better for maximizing post-tax returns, despite the lock-in.